Welcome back to Fast Money. The market's closing well off the day's highs, with the Dow barely holding on to a gain, though the Nasdaq rose more than 1%. This as the Fed kicks off a two-day meeting tomorrow. Our next guest believes investors will have to cope with rolling corrections that will last beyond Election Day, but it's not a bearish call. Tony Dwyer is the chief market strategist at Canaccord Genuity. Tony, great to see you. So you still think we could hit record highs?
Yeah, I don't think we're really focused on the long term here, which is an extraordinary setup. We've talked about it in the last couple of times I've been on the show, Mel. You've got a historic level of excess liquidity that's in the marketplace, coupled with a synchronized global pivot in the economy. It is really extraordinary. It looks so much like that fall of 2009 when you started a new economic and market cycle, but volatility picked up because you had had such a run off of the low.
So the Fed, in your view, is sort of the floor under the market. The unknown that can cause this volatility is the elections?
So you've got a bunch of unknowns. You've got election. You've got geopolitical risk with China. You've got COVID-19 vaccines. You've got obvious economic recovery. Those are the unknowns, but they've been with us for the whole time. The one thing we do know is, for the first time in my 30-plus year career, I got a Fed chairperson that's literally saying, don't worry about the deficits. We're just printing money. And they just revamped their policy to prove it. So when I've seen corrections, we were looking for a 3 to 7% correction. We still are looking for multiple 3 to 7% corrections, like the fall of '09. But in my career, I've always heard the Fed say, this isn't going to last forever. The deficits are unaffordable. At some point, we're going to have to pay the price. But the opposite has been said with this Fed. And the reason is low inflation has given them the ammunition to be able to do it.
Tony, when you mentioned the synchronized global pivot, what precisely did you mean? And does this assume that the U.S. economy is pivoting itself?
Yep, it is. All the data is there. So, Mel, let me explain the main factors I'm going to talk about for a long time. Excess liquidity is the amount of money that's readily available against what is needed for economic growth. We saw a record move in that. Industrial production is picking up, so the economy is improving domestically. So that reading's coming down, which again reinforces that you're on the other side of a recession. And the global pivot in economic activity is the Organization of Economic Cooperation and Development, the OECD, puts out a data series of the 37 economies they follow, showing which ones have composite leading indicators showing positive gain or above average. That hit 0 for 2 months in April and May. And then it pivoted off of that low with month-to-month readings of 90%. In other words, we knew that 0 were positive, but that you were having almost every one of them have an uptick month to month. The only time I can find that happening is, again, the summer and fall of 2009. So our case isn't that this is going to get crazy with the election. Who knows which side is even going to accept the results? That can create the opportunity. But as long as you've got that combination of economic catastrophe and market sustained drops happen when there's a credit crisis and you believe that you need money and don't have any access to it. The opposite is true today. And even though it's not a perfect, I don't want to go all the way back up in the next minute. I wish we did for the people that are unemployed and the small business owners, for sure. However, I would like to see a good, consistent recovery, because that keeps all the factors that are currently working for the market in play.
Tony, good to see you. Thank you.
Thank you so much, Mel.
Tony Dwyer, Canaccord Genuity. Tim, your thoughts?
I think Tony did a fantastic job explaining monetary policy in the context of markets and the Fed put, which I agree with and I've talked about. If you buy that theory and you buy some of that pivot on the leading indicators, remember, we're going to talk about FedEx later in the show. FedEx, which started to trade off dramatically in January of 2018. There was a number of other leading indicator stocks and transports. Transports have outperformed the S&P by 25% since the lows of March, and they will continue to. But related to that, again, the resource resources trade. Look at things like Rio Tinto, a name, Mel, we talked about a decade ago. That is at all-time highs, or it's about to near post-crisis highs. Vale, other resource companies. Those trades are part of this trade into the industrials, and those that I think we're suffering and we're leading indicators on the way down. Those are some of the best charts in the market right now.
I mean, Victoria, if you do believe Tony's thesis, you should want to be in cyclicals.
Well, I think you want to have some exposure to cyclicals, right? Because you do have the Fed saying, look, we're going to be with low rates till 2023. That's going to give equity valuations a boost. You're going to have liquidity in the market. And maybe that causes a little bit of inflation, but I mean, does the Fed care? I don't think they do when they've talked about the new way that they're going to look at monetary policy. So you've got a runway there. We still think, though, that secular growth story is important, so we wouldn't do a full shift into cyclicals. We think you need to have kind of a barbell approach and have some of those names in there, but look at those growth names as well and keep those in your portfolio. They're still going to have some room to run.